So in this chart, I'm going to examine the big picture fundamentals as I see them. I've been warning people for a couple of years that that this was coming, and I said back in August when we completed that intermediate cycle low that the market would start to accelerate to the upside. We would enter a vertical market. My mantra has been 10,000 is going to be a piece of cake. 20,000 isn't out of the question. 6 months ago, most people laughed at me. Now I suspect there's very few people that even disagree anymore. Um, at this point, it's clearly obvious that the stock market is uh, in a bubble. Without doubt, we're starting to go parabolic. I'm still not completely sure that we aren't going to get some kind of a correction first before the real parabolic phase begins. Um, the semis hit that 1362 level today. That's a major resistance zone. That would be a potential spot for that sector to take a breather. And if the semis, the leading sector, take a breather, I would think the rest of the stock market probably would as well. But you can look on the chart here. This is the Dow. I've got the 200-day moving average on here, and you can see how once we finish that correction in August, how price has really started to accelerate, and then once we started the new year, it's just going vertical. So there's no question at this point that we're in a bubble. Now there's going to be consequences to that. At some point bubbles burst. I'm pretty sure that the first bubble, Bitcoin, I'm pretty sure that has already popped, and now the money that was going into Bitcoin, any institutional money that was into Bitcoin has probably gotten out near the top, and that money is now going into the stock market, driving the stock market higher. Well, there's going to be, at some point, there's going to be a spot where the stock market bubble pops. And what are the consequences going to be of that? I'm pretty sure that the consequences are going to be the same as they were in 2008 when the real estate bubble popped and the stock market topped. The liquidity is going to find its way into the commodity markets and create inflation. Oil has already rallied further than I was expecting. We're up around $64, and I was kind of expecting a top somewhere around 62. So we're already starting to get more inflation in the energy market than what I was expecting this early anyway. So and gold has clearly completed an intermediate cycle low here. The dollar is breaking down out of its megaphone pattern, and despite the ECB trying to intervene and stop the euro from rallying, I don't think they're going to be able to do it. So the intermediate cycle, as I've been saying, I'm pretty sure this is the cycle where gold breaks out of this basing pattern it's been in over the last year. And so it seems pretty clear to me that big money, smart money, is already starting to position, some of that money anyway, is already starting to position for the inevitable popping of the stock market bubble. And I think that's going to create, when that happens, that's going to create a bubble in gold. Will be our third bubble. We're gonna, like I said, we've already had a bubble in Bitcoin. We're getting well into the vertical phase in stocks. Maybe we'll get a pullback here in the next couple of 2 or 3 weeks. But once that pullback is over, if we have it, then we are going to go parabolic in the stock market, and that parabolic move is going to end just like the Bitcoin bubble did. It's going to pop, and then the consequences are that the liquidity is going to flow into another area, and I think the gold market and the commodity markets in general are we've already got smart money that's starting to enter these sectors in preparation for what's going to come when the stock market bubble does pop. Okay, so now I'm looking at a long-term weekly chart, and I'm going to show you why I think most of the liquidity will focus in gold, and we'll get our bubble probably in gold, not energy. The bubble in energy occurred back in 2008. So you can see here during this bear market, the gold market not only held well above the 2001 lows, it wasn't even close. It also held above this 2008 C wave top. So this is more or less just a normal D wave decline. It took a long time to get there, but it basically did the same thing as this D wave decline, came down and tested the prior C wave top. C wave top, and the D wave tests it. And then now you can see that gold has rallied back above the 200-week moving average. It's held that 200-week moving average during this intermediate cycle low, yearly cycle low, and now we're moving up. So gold has been considerably stronger than oil in the CRB during this bear market phase. Moving on to oil, I showed you where gold went to during the bear market. This is where oil broke the 2009 low. Gold wasn't even close to breaking the 2009 low. So gold has been showing a relative strength when comparing it to the energy market. And the energy market was not even that far away from testing the 2002 lows. So the energy market has just been much, much weaker than the gold market during this entire bear market phase in commodities. When we look at the CRB in general, the CRB actually did drop below the 2002 low. So, when compared to gold, neither of these markets, either the CRB or the energy market, are showing the kind of relative strength that gold has during the bear market. So here's the chart of gold. You can see it's holding above the 200-week moving average, and the 200-week moving average is turning up. And whereas oil and the CRB actually tested their 2002 lows, gold did not. It actually didn't even come close to testing the 2008 low. So this is where the relative strength is. This is where I think when the stock market bubble pops, this is where the money is going to focus that comes out of the stock market. Smart money is already taking positions in preparation for what is going to happen when the stock market bubble does pop. And finally, this is a chart of the euro. You can see I've got the bear market trend line drawn in here. I'm going to virtually guarantee that no matter how much the ECB intervenes trying to turn this back down, they are not going to stop the euro, the intermediate cycle in the euro, from at least testing this bear market trend line before this intermediate cycle tops. So there's no chance that gold has completed a larger intermediate top, and it's not going to complete an intermediate top until the euro at least touches and tags this bear market trend line. And that's we've still got a ways to go before we get to that point yet. So I'll say it again: 5 weeks is way too early for an intermediate cycle to top in gold. At some point, we'll get a daily cycle top, but I'm not going to try and guess when that will come. People have already tried to guess and gotten caught, and it's just dangerous to try and time wiggles in a first daily cycle. There's no telling how far it could go. it's even conceivable that the rally in the euro could get all the way to this trend line before this daily cycle in the euro tops, and that would probably push gold up to the 1400 area before the daily cycle tops, and then we could get a breakout above this trend line during this intermediate cycle. So there is just no chance that either the euro or gold have formed a larger degree top yet, and it's just not going to happen until the euro at least tests this trend line.